How is due diligence done for seed funding? Imagine you're about to invest in a new startup. You want to be sure it's worth your money. That's where due diligence comes in. It's a process investors use to check if a startup is ready for seed funding. First, investors look closely at the founding team. They want to see if the founders have the skills, experience, and dedication needed to make the business work. They review resumes, past projects, and how committed the team is to their idea. This is because early startups depend heavily on the founder's ability to lead and execute. Next, investors evaluate the market opportunity. They want to know how big the target market is and if there is room for growth. They look at industry reports, competitor analysis, and customer demand. If the market is too small or too crowded, it might not be a good investment. Then they review the product or prototype. Usually, startups at this stage have a minimum viable product or a prototype. Investors check if there is proof of concept, like customer feedback or initial sales. They want to see if the product solves a real problem and has potential for expansion. Legal checks are also important. Investors verify that the startup is properly incorporated, often in a state like Delaware. They review legal documents such as incorporation certificates, founders' agreements, and intellectual property protections. They want to make sure everything is legally sound and compliant. Financial review is next. Since seed startups usually don't have a long financial history, investors look at basic financial models. They check how the startup plans to use the funds, its burn rate, and if the financials are realistic. Proper accounting practices, like separate business bank accounts, are also examined. Investors then review the cap table, which shows who owns what. They look at ownership stakes, equity agreements, and any obligations to advisors or early investors. This helps them understand how ownership is distributed and if there are any potential conflicts. For startups with intellectual property, investors assess whether the IP is protected and if the startup has a clear strategy for using it. They want to see that the startup understands its IP landscape and has taken steps to secure its innovations. Since seed funding involves less operational history, the due diligence process is usually shorter and simpler. It often involves reviewing documents sent via email or a secure data room. The process can take from a couple of weeks up to 2 months, depending on how prepared the startup is and how thorough the investor wants to be. From the startup side, preparing for due diligence means organizing all legal and financial documents. Being transparent about your business model, market size, and team strengths helps build trust with investors. Clear communication and readiness can make the process smoother and faster. In the end, due diligence for seed funding is about making sure the startup is solid enough to grow. It's a careful check of the team, the market, the product, and the legal and financial basics. This process helps investors decide if the startup is a good fit for their investment portfolio and if it has a real chance to succeed.